Good afternoon, everybody. Welcome to a new wave of lending. My name is Mortgage Mike Alvarez with Shore Capital Corporation. My mortgage experience is almost 20 years in Florida and California. I've closed nearly every type of residential and commercial loan and land loans. Our company helps purchase or refinance any real estate loan for less. You might ask if real estate mortgage rates are really in the twos and with rebates. If you need to brainstorm on a mortgage, please call me and we can learn which mortgage is best for you. Loans we do are VA, conventional, FHA, USDA, self-employed, jumbos, 80-15s, fix and flip real estate, residential, first-time, commercial, foreign national, investor, hard and soft money, interest-only HELOCs, generally speaking, any loan secured by real estate. Today, we want to focus on what they call the non-quantitative loans. That's the new term for something besides conventional and FHA. So, what types of loans are these? Basically anything that are not conventional or FHA or VA, basically no government insured loan. The types of borrowers that these are more likely to help would be the self-employed borrower, the credit challenged borrowers, maybe they had a recent foreclosure or short sale, investors. There's something called a debt service coverage or even a no income loan for investment properties. We'll talk more about that. For national borrowers, asset qualified borrowers, this is where we take your assets and divide by usually 10 years. Anyone that has really good cash flow but has a challenge improving it, or maybe distressed credit, just something that keeps them away from a conventional loan, this is our topic for today. If there's questions that come up along the way, I'm told that there's some way that those can be piped in to me, so I'm sure the guys will cut me some slack, give me a break, or give me some insight as to what questions could come up. I am looking at a full doc loan here. This is someone probably that has less than perfect credit, maybe a 580 score. Generally, this person has 20% down. They can prove their income, it's very routine. They can get a 30-year fixed rate. We want to see 2 years of 1040s on this person. It's kind of a vague term, really 2 years of full doc, but what they mean by that specifically is 1040 tax returns. An alternative to full doc loan, and so talking about available doc types. So I guess we'll go into more detail on this as we go along. Full doc is a couple years look back, 12 months of bank statements or a 1 year 1 year tax return for self-employed, 6 months of bank statements again for self-employed. There's asset depletion, which seems like I just said, and then the debt service coverage ratio. And this is largely for investors specifically. So options for the self-employed borrower. There's a great deal of options for self-employed borrowers, and a lot of them are not very well known. 6 and 12 months bank option statements are well known. 24 months is better than either of those. Generally now the default would be to get your friend, the CPA or professional tax preparer, to help you prepare a profit and loss. This is something that I can also do for you. It's often as simple as going through your bank statements and recording as is your usual custom, money in and money out. The idea is that you want to, make yourself look good and consistent compared to previous years. Both personal and business bank statements are allowed, so I don't want to say if you were commingling funds, that's not illegal, but some people use their personal banking for their business, and that aggregate of cash flow can be used up to 100%. They do try to separate, what the cash flow is, but they do assume that all that money is yours. With the business, I see we're saying that it's 50% of deposits. That fluctuates wildly depending on the lender. It's generally accepted they'll take as high as 80%. I have seen 100%. 50% is a little bit of a low number that we're showing here. COVID has kind of put a cap on some of the risk, but that is rapidly returning to normal. We're seeing a great deal of normalization from the COVID problems. Up to 3 accounts allowed. That's something of an exception with this particular lender. So if you had like 2 or 3 business accounts, maybe you just transferred banks, or you just had 2 business accounts for whatever the reason. As long as there isn't a duplicity, they kind of are going to be careful not to count the same deposit twice, not to count a transfer from one account to the other account as income. The most exciting of this on this list for self-employed borrowers is a 1-year tax return. People are often coming to me in October and saying, how much money do I have to claim in January so that I can buy my house? If your credit score is great and you're putting 20% down, you're totally eligible for a 1-year look back. So I'm not going to average 2 years of your self-employed income. I'm going to take a 1-year look back. We're going to put it in the computer, and the computer's going to say, this guy's got great credit, right? And there's a couple underwriting engines. The one LP will really take that forward. They favor better credit as opposed to better income. So the 1-year tax return option, if you have questions about it, it's something that's easily to expand on, and you can pretty much make your 6-month plan in October or November and know how things have to work out for you. Up to 50% DTI with residual income. So maybe you don't have a W-2 job or something of this nature, even self-employed income, but you have a great deal of passive cash flow from properties or something similar to this. That's still at a dare I say, progressive calculation for regular income. It's going to be very similar. 50% is a standard back-end ratio, and so you're not getting penalized just because you have residual income from positive cash flow properties.
What credit score, Mike, do you require for that type of self-employed loan?
Self-employed borrowers benefit from having a 700 credit score, but any of the programs I'm bringing forward are going to be, generally speaking, in the conventional sense, a minimum of a 640 or 660 score. We're a little bit impacted by COVID. Ordinarily, I would have said 620. All of the banks before pre-COVID would have said 620, but we really will give you special treatment if you have a 640 score.
So 640 would be like the minimum score right now with today's,
Across the board, 640 is something of a minimum score. Again, things are getting back to normal, so we do get advertisements now for the disparity going away.
640 is not bad. 640 is actually really good.
Yeah,
640 is a really good score.
In the sense where I'm doing something other than what's usual, we want you to have a 660 score. And self-employed people are looked at, with a larger lens. You're put under this huge magnifying glass, and they somewhat discriminate, I think, against self-employed borrowers. I mean, we all know that already, I think.
Yeah. So 12 months bank statements are fine, and with the 50% back-end ratio?
Yes. The only thing I would say is be prepared to have your friend, the professional tax preparer, prepare either a year-to-date P&L.
Okay.
I mean, oftentimes I can help with that, the closer we are to conventional, the less likely that's going to be a problem. Because you have a 1040.
We're mostly, mostly interested in individuals that are definitely not going to go conventional or FHA, which are going to be strictly just, bank statements or an accountant's letter, something like that type of program. Do you guys carry programs like that?
Yeah, we were just running through it. We had the 6 and 12-month bank statement program. Goes 24 is better than 6 or 12, but a lot of times having that CPA volunteer his credentials as, this guy's telling the truth, or it's basically reconciling what's probably reflected in your bank statements already. But a lot of times they only care to get something from a CPA.
Right.
CPAs are supposed to take direction from us, right? Self-employed people who are, in effect, our own CEOs. We're the ones.
Do you mind if I join you up there and I can ask a lot of great questions?
Come on up, man.
Learn more
Whip it
about
out.
these programs.
Get on me.
I'm more excited than you are.
Okay, so.
Hey guys, how are you? How's everybody
You
doing?
guys recognize this guy?
How are you? Thanks for having me, Mike, here with you.
Yeah,
Okay.
thank you.
I'm totally more excited about these programs than you are. You're the lender and I'm the realtor, but the problem is that I'm a self-employed individual. And, I'd have to say over 60% or about 50% of America are self-employed individuals. They're tradesmen, they have their own lawn maintenance companies, they either do tile, they do electrical work, AC work and things like that. So I'm personally, because we have so many clients like this, we're really, really interested in these type of loans, Then we have so the more we know about it and the more we got great lenders like you here, the more we're able to help our public. So 640 would be like the bottom score right now.
Well, it's a floor for the least. I would say, I think I get into scores here a little bit later, but a 580 score.
Wow, but that's more into a hard equity loan.
Yeah, you'll pay. The difference will be in the rate. Like I say, self-employed people are held to the higher standard, and if you want a rate that's single digits,
yeah,
Mostly
I ask these questions because the reason is that truly, I've been an investor my whole life. I'm still an investor. So I'm really interested in be able to flipping homes, the buying and selling of homes. And again, by helping individuals as well too, with the self-employed loans, because a lot of the tradesmen, they can't get a conventional, they can't get an FHA loan. But most of these loans the terms are how long of a term? 5-year, 10-year, 3-year?
With rates being as low as they are, there's very little difference between the 5-year and the 30-year.
Right.
Thinking back on your question, a lower credit score is more likely to impact the LTV, where they might have lent, 75 or even 80 or 85 for that great score. Now they're thinking, 50 to 65, because the score is lower.
Yeah. Well, one of the things I've seen of tradesmen make good money. They make really good money. Okay. You have a lot of individuals that drive trucks, the 18-wheelers and things like that. There are so many different types of tradesmen that there are in self-employed individuals. So they have the capital to be able to send towards the principal $10, $15, $20, $30, $40,000 a year. So truly, when you look at one of these non-QM loans that you guys do, and you look at a conventional loan and you look at an FHA loan, you're actually paying less interest rate because of the term. When you do a 30-year loan, okay, even at a low interest rate, you end up paying what, 3 times the amount of the loan, of the principal?
That is a great question.
Yeah.
A little bit hard to answer because people don't like the idea of an interest-only loan or...
I'm with you on that, but today we're actually here to help realtors and their clients that do not qualify for a conventional loan. So when you guys, as the realtors, that you guys hear that the interest rates are higher, this should not scare you one bit at all. Because if you guys do the math, and I'll be happy to do it with you, and I've done it in many, many classes before, when you guys do the math, these non-QM loans, you're actually paying less interest rate in the long term than you are doing a conventional loan. A conventional loan or an FHA loan is a 30-year amortized loan. That's a long time. That's a really long time. Okay? So at the end of those 30 years, take a look at how much you really actually paid for that property.
The investors have a different horizon. Usually it's a
Precisely.
5-year horizon.
Exactly.
And they're more aggressive in paying down principal.
Exactly.
And that really is the secret.
Exactly. And that's our clients. Our clients, my clients, because I've been an investor, I'm going to be an investor until, the last days of my life. I will always be an investor. And I've done many loans with Mike. Thank you, Mike. Glad to
have your confidence again.
And I'm glad that we've got these self-employed loans again, because before COVID-19, these loans were very active.
Yeah.
They were there, and now everything's just starting to stabilize again. So now we're able to help our public and our clients that, that are self-employed, where in February, March, April, we weren't. Those loans weren't really available. But thank goodness they are now, So 640 score, that's a pretty good score. Almost anyone has a 640 score.
Largely speaking, if you have
Yeah.
3 good accounts with no lates,
Yeah.
you probably have a 640 score.
Yeah, absolutely, right. And 50% DTI, which means the ratios, would be the income divided by the debt. Again, that's pretty good. So
Yeah, half of your income would go
Yeah.
towards housing
Yeah.
and your other debts shown on the credit report.
yeah. So we can't go over 50% DTI, or are there exceptions?
There are exceptions to 55.
Up to 55. That's still darn good, Mike.
Yeah.
I really mean that. That's still. And I like your last name, by the way, too, Alvarez.
I've admired yours too, for some reason. Yeah, yeah.
I don't know. We're probably related somewhere down.
I've been
the
doing a
history
search,
line.
actually, to see if maybe you'll adopt me.
Mike, I don't know. We'll have to speak that with our kids. We'll have to do a reunion and
There we
sing us all
go.
together
See if we
with
can
the
find
kids
it. Okay.
and see. Well, I have this one gentleman. He's a lender. Let's bring him into the family. He's the right lender.
Okay.
So that is phenomenal. Interest rates could range for, of course, I would imagine, this is without me, knowing, because I haven't spoke to you in a while. The higher your credit score, is this true or not? The better the interest rate, the lower the credit score, the higher the interest rate. Is that valid at all?
Yeah, most of 99% true, I'd say.
Got it. So the better your client, I seen this. I talked to a self-employed individual just this week, and the gentleman impressed me. Like a 780 score. I go, oh my
Nice.
God, phenomenal. Actually it was a young lady, a 780. So 780s. Yeah, I mean that's not unusual to see. And then.
Yeah, no, 700 is kind of a benchmark for investors. If you 680, 700, and if you have a 700 score as an investor, your transactions are going to go really smooth. 660 is probably the floor, and again, there's going to be exceptions, but the trade-off will be probably in the LTV and maybe a little bit in the rate as well.
Right. Prepayment penalties, it's really important. Prepays, because that we have to calculate when into our expenses, especially for someone as myself that buys and flips homes. Okay, so that's part of my expenses. So whatever the prepayment penalty is, and again, how does that prepayment penalty vary? Does it vary because of the LTV? The more you put down, the lower the prepayment penalty would be, or the other way around.
Prepayment penalty would vary by, I would say the most reliable indicator is going to be the rate. If you're coming in with a low rate and it's some kind of alternate doc loan,
Right.
then you're going to have a prepayment penalty because the investor has already accepted a low yield in exchange for your good credit, but these are more aggressive investors, so they're
Right.
going to want a fixed rate of return because they promised that to somebody else.
Exactly.
The other guy says, he's maybe going to take a lower LTV, he's going to push the rate up, and he's making his profit on the front end and not over the term of the loan.
Precisely.
So that guy is more likely to have like a 1-year prepay compared to say a 3-year prepay.
Right. Well, let me explain something to our realtors, okay? A all of these loans, they do have prepayment penalties. Us as realtors, we provide two services. We provide one service to our public, that where we help them, either buy, sell, rent a home or a commercial building. The other service is something that we provide to ourselves, okay? Now, a lender, they sell money, okay? So they don't want you to borrow, and this is all lenders, they don't want you to borrow the money and then buy a home, and within 2 months that you are returning the money back to the lender. They made no money. They lent you a couple $100,000, and what they got back in return was a couple of $1,000. That doesn't make sense, okay? So whenever there's a prepayment penalty, that's actually normal. There's always a prepayment penalty. If there's not a prepayment penalty, it's like what Michael said. There's points up front. So me personally, as an investor, the way that I would do it, and this is just an opinion. It's good to hear opinions, different opinions from like one individual, another individual, and today you guys get mine. So anyway, I don't mind the higher rate and the lower prepayment penalty. Like, for example, a 6-month prepayment penalty, and then a higher interest rate. When you figure it out, you're paying less. You're actually paying less than getting a lower interest rate. And now you're thinking to yourself, and this is good because you guys need to know this thing as realtors. You guys have to know these things so you can explain it to your clients. The more intelligently that you explain it to your clients, the more your clients are able to understand it, grasp it, and then work with it, okay? So again, I prefer a higher interest rate with the lower prepayment penalty, to where if I was to get a lower interest rate, and who am I really kidding? Okay, I'm getting a 6%, 8%, 8.5%, 9% interest rate, but I've got a 2-year prepayment penalty. Do the math. You're actually paying more. You're paying a lot more back, to the lender. So interest rates, high interest rates, I've done loans that I've paid 15% interest rates. And even after I flipped the property, I've made my income,
Your yield.
my yield, okay? This is after cost, repairs, after expenses, everything. I am still excited because I walked away with a profit. That's called yield. I think that's you. You are our yield.
Yeah.
We love you. You are our yield. We're lucky to have you, Mike. We really, truly are. We've been working together for many years. You're a phenomenal lender, and you provide great service. And but I do want our realtors to know that a high interest rate is not it's not a 4-letter bad word. It's actually something good, because with the money from the lender, we're able to buy and flip homes and make a profit.
So
great profit.
Ishmael is pretty much a very experienced investor, so he's not looking at his expenses, he's looking at his yield, and that's his focus.
Exactly.
You don't care if your interest rate is 15% if you're making 80% on your flip. If you're making an 80% yield.
Even, Mike, I didn't mean to interrupt you, but even if we walked away with $30,000, okay, that is a phenomenal yield on an investment. Even if I walked away with just $30,000 net, there are individuals that work an entire year and they don't see $30,000 at one given time in their hand. So if you do 4 homes a year, at making $30,000, that's $120,000 a year. That there are individuals that will never see that in a lifetime, all at one given time. They'll make $120,000, but they'll never see it. But us as realtors, we're very privileged. We're very privileged to have this license as a realtor because, again, we do service and we also do investments for ourselves. And then the way that it won't work, going the contrary to everything I just said, for a self-employed individual, is getting the lower interest rate, and then I don't mind a 3-year prepayment penalty or a 5-year prepayment penalty. Why? Because you're able to depreciate that home if you're renting it out. If you're doing a rental for the next 5 years. So the longer the prepayment penalty, I'm okay with that than if you were to give me the lower interest rate. Because now I start buying homes. We've gotten a couple of realtors here that are fairly new. They've had their license for less than a year. And I was just talking to one of them last week, and he's got 3 properties that he owns already. By the way, the gentleman's 27 years old.
Nice.
Very nice. By next year, he'll have another 3 or 4 more properties. By the time he's 40, 50 years old, you know, I mean, the guy's got a very nice nest egg put away.
How about that passive cash flow you're talking about?
Absolutely, with the passive cash flow. And not only that, there is no good time or no bad time to become a realtor. It's at any age, strictly at any age. Because if you start using this license correctly and start having, you know, great lenders as Michael Alvarez here, you know, we're going to benefit. We're going to make money. We're going to make money. The thing about it is, I have some investor friends of mine that began with me with 1 home. They own like over 350 homes right now. And I brought them in. They did a very nice episode that we did just on investors alone, you know, how to become an investor. And one of the things I asked these 2 brothers of mine, really good friends, and I asked them was, what do you guys recommend? If you guys were to give some advice to all of our audience, to our realtors, to our investors, what do you highly recommend to get their real estate license, to get their mortgage license, to know all about mortgages? And their key word was, no, they need to have the incentive. If you guys don't carry the incentive of wanting to do this, it's not going to happen. I'm here today because I wanted to hear all about Michael's programs. Why? Because I want to buy at least, from here to the end of the year, at least 2 or 3 more homes. Not a bad ending of a Christmas, okay? If I flip 2 or 3 more homes.
It's a good December.
Yeah, I think it would be a good December, you know. But if I don't have that initiative, if I don't have that incentive, and if I don't have Michael Alvarez, okay, I'm in trouble. I'm actually in trouble, you know. So we're excited. We're excited to have you here. We're excited that you're sharing all your great programs. So on these non-QM loans, which are they're self-employed. These are people who are 1099s. These are people that when they get their paycheck, whether it's on a weekly basis or bi-weekly, there are no FICA, there's no Social Security, there's no Medicaid taken out. That's a self-employed individual. It's a 1099. Now, an individual who is a salary employee that they do take out FICA, Social Security, and Medicaid, that's a salary employee. Those guys qualify, and gals, they qualify for conventional loans and FHA loans, very, very normal. But that's just probably 50% of our public, especially here in Florida.
Small business, the backbone
Yes.
of America,
Yeah.
you know, common knowledge.
Yeah, small business, the construction that we've got going on. Are you kidding? South Florida is all about construction, completely about construction. So we need to help them. We need to help them buy their homes, and even buy more homes and investments. You know, for investor loans, again, going back to these 1099 self-employed loans. So it's phenomenal that we do have these individuals with a 640 score.
Right.
The interest rates will range. Let's say we have someone that's the young lady that I met a few days ago at 780, and they've got 30% down. What would you recommend for them?
She's not a full doc,
She's not a full doc. She's self-employed.
and she wouldn't have tax returns.
Does not. She does have them, but as many individuals that are 1099s, their tax returns aren't, appropriate.
Representing.
Well, maybe not. I'm using the wrong word.
Representative of what their true income is.
Exactly.
Just someone with good cash flow. It'd probably be that CPA or that number of months bank statements program. Where you get the CPA signed P&L or
Got it.
6 or 12 months of bank statements.
Wow, 6 months of bank statements only. That is phenomenal. That's a new one.
Yeah,
Didn't know that one.
they're like 6 to 24. They had one that was 1 month and then COVID hit. So there's going to be some vacillation here, but the catch-all really is going to be a relationship with your tax preparer.
Right.
And it doesn't have to be a CPA, it can just be someone that's in the business,
Yes,
you
an
know,
accountant.
an accountant.
Yeah,
Just
exactly.
any a professional
Yeah,
that they
right.
can find, you know, online or something. Or
That is phenomenal. That's truly phenomenal, because we truly know that, you know, again, this is my guess. I have no statistics on this whatsoever, but based on all the individuals that are walking into our office, half of them are W-2 employees, and then the other half is 1099s. And we are here to help them all. We're to help everybody achieve buying their home or becoming an investor. You know, there is no restrictions on. I know one lady, she's got like 17 homes already. Phenomenal. But she doesn't flip them. She rents them out. She rents them out. She's doing a phenomenal job. You know, and I would love for her to meet you. Well, I think she's going to meet you now.
oh, okay.
Now she knows who you are. Now she knows who you are, and your phone number is all over the screen, so they'll know how to get a hold of you and so forth. Question: there are a lot of individuals as well too that they don't deposit the money into their personal account, but they deposit it into their business account, whether it's a corp, whether it's an LLC, whether it's an enterprise. Can you work with a corp, an LLC, or an enterprise?
Often enough for an investor, often enough they prefer it.
They prefer. Is that a
Yeah,
word?
well,
They
prefer, but yeah,
Yeah.
they want it that way.
Yeah. So that's phenomenal.
Yeah, it's sometimes there'll be a compromise in the amount of income they'll allow for, but which you have experience with, they count most of it.
Yeah,
You know?
up to 50, 60% I've seen. But that was before the COVID-19. I don't know right at this point.
I've
of
seen
the
it
income coming in.
We see it up to 80%.
Oh my God,
I mean,
things are getting better, guys.
A floor is 50%, but you know, business account often, like I have a business account,
Yeah.
I have a personal account. My
Yeah.
business account receives business receipts. All of it is business.
Exactly.
So they cast an eye to see, well, what's the nature of these deposits?
Yeah, you know, that's really good news. I'm learning a great deal with you today, because I didn't know that if someone doesn't have a personal account, they really deposit all their money into their business account, that you guys will look up and, you know, accept up to 80% of the income coming in. Wow, that's strong. That is really strong. That's truly strong. 80%. That's buying power. That's great buying power. How many months of bank statements will they need at that for a business account loan?
More is better.
Got it.
They'll view it in terms of the stability of the business.
Got it.
So 24 months is the clear victory.
Right.
If it's 12 months, it's 12 months. If it's 6 months, it's 6 months.
Right.
But again, that catch-all
Right.
will often be, you know, the year-to-date P&L or the audited 12-month look-back, you know,
Exciting.
with your from your CPA,
Exciting.
which I can help with. You know, like
Phenomenal.
I've made a few for people and said, give this to your CPA so he doesn't charge you $5,000.
Exactly, because sometimes they do take advantage of something.
Yeah,
And all it
depending on
is
your
just
CPA.
a simple verbiage that's required. It's just a simple verbiage that's required. One of the really good things, again, is that we're able to assist us at Partnership Realty. We're able to assist with Michael's help, of course. We're able to assist all these self-employed individuals that are out there that are tired of renting and throwing their money away. So now they get to own a home. And again, I will repeat this, and I'll repeat this 100 times, and I will sit with anybody at all, that because when you're self-employed, you're actually, even though your interest rate is higher, you're actually paying less interest rate, because the term is, sometimes these homes are paid off within 3 years, sometimes they're paid off within 5 years or 7 years, because you guys have 7-year loans as well too, right? 7-1 ARMs.
We do have 7-1 ARMs. Something that is new that I'm recently certified for is the interest only first for investment properties.
Yeah.
Again, not very popular because it's interest only,
Well,
but it does save a lot.
let's talk about that for a second, because I really would like our, our audience, and I really would like our realtors to understand an interest-only loan. I'm all interest-only loans. I think every loan that I've ever done with you has been interest-only. I don't want anything to go towards the principal whatsoever, because I do short-term loans.
The idea of an interest-only loan versus a fully amortized loan,
Correct.
excuse me, is the interest-only loan, the interest is calculated on a daily basis. It's what's called a per diem loan.
Precisely.
So it's, if you have 31 days in a month, interest is calculated 31 times. The HELOC has the advantage in that you could put money in and take money out, and on the days the money is in, your interest expense is lower.
Exactly.
Compared to an amortized loan,
It's there, it's fixed.
the first two-thirds of the interest is front-loaded into the first third of the loan.
Precisely.
So when you make a payment, a smaller portion is going towards principal.
Precisely. Oh, no, without a doubt. All lenders will they collect all the interest up front. Why? I'm not knocking on you guys. Our conventional FHA lenders, we love you guys just as much. Oh, thank you so much.
Thank you.
Thank you. We love you guys just as much, okay? But what Michael is saying here, honestly, on an interest-only loan, it's phenomenal, because we're able to pay these loans off, because while I have this a 5-year loan, it's called a 5-1 ARM. For the first 5 years it's fixed, then it goes into an adjustable, or a 7-1. Just depends on how long I want to keep this house, how long I want to get a return on it, a positive return, cash flow on it, okay? And sometimes I want to sell them within a couple of months. But when I've got these 5-1 ARMs or the 7-1 ARMs, I'm always sending towards the principal. Every 2 months I'm sending $30,000, $20,000, $15,000, and you're reducing the principal. So as you reduce the principal balance, the interest rate is based on the principal balance. Am I correct on that or not?
Yes, any additional payment you make reduces the
Your principal balance.
Yes.
Precisely. So the monthly payment's going to be reduced as well too.
And your monthly payment will drop because now the principal calculation is lowered.
Exactly. And I don't plan, I've owned many, I can't tell you how many homes. I've never paid off a home. It's never taken me 30 years to pay off a home, because I am not going to pay off a home 4 times its worth in value. I'm not doing that. Conventional loans are great, but today this is not a conventional loan class. We do FHA classes, we do conventional classes. They're all phenomenal, they're great classes. But today is a self-employed class. It's an investor financing class. So we need to know the pros and cons and the benefits of them both, because everybody has different, different goals on what they want. Some individuals are fine with buying a home and paying it off for 30 years. I don't think so. I got better things to do with my money.
It seems
than
like
to give it to, I'm not going to mention any of the big banks, but that's why they're multi-billion, gazillion rich, because they make a gazillion dollars amount of money on your $100,000 loan. We're here at the higher interest rate on a 3-year loan, on a 5-year loan, they're actually making less, because how much can you really make? We can do the math right now. 15% on a $50,000 loan, $60,000 loan. That's a small payment. I would need a calculator for that. But
60 is about $9,000.
$9,000 a year. That's not a big return.
No?
If I lend you $60,000 and I'm getting $9,000 back, I don't know. It's not. I think I have other ways of working with my money, but investors,
And then you
they
flipped
don't
it,
right.
and then you made your 30,000.
Then I turn around and make my 30,
Right,
40,
so
50,
the
60,
9,000 is
80,
nothing.
or even $100,000.
Well, yeah.
And
Net,
more.
Net.
Exactly. With your loan, of course.
Right.
So that is phenomenal to hear that you guys are doing loans for corporations.
Yeah. For investors, it's
phenomenal.
often preferable.
It's also preferable.
Often preferable. In fact, they now do it for Florida Land Trust. That's new.
Wow, yeah, so that's phenomenal too.
Yeah.
That's great, that's great. So different entities, you know.
Yeah, I found that out yesterday, actually. Yeah, they opened it up 2 years ago. It wasn't possible.
That is phenomenal. So we know we could work with personal bank statements. We know we can work with business bank statements, and so that's a great opening, because the more we know about mortgages, the more we know about financing, the more we can help our audience, our public, our realtors, and so forth. You know, so that is great. Anything else you would like to share about the QM loans, the self-employed loans? Because I do want to ask you about hard equity, really hard equity loans. These are really hard equities.
I don't know. What do I have here? Debt service loans for investors. I probably would have mentioned that if you're an individual that has not a lot of income but a lot of liquidity and you wanted to buy something,
Exactly.
we'll take your income divided by 10 years, or not your income but your net worth. So if you're $3 million relatively liquid, divide that by 120 months.
Yeah.
Is that right? 10 times 12?
Yeah.
And that'll be your monthly income, and then you qualify for
Wow. You guys have a lot of great programs, Mike.
that. I want you to have a good credit
Yeah.
score, the foreign national stuff. Hard money,
Before we get into hard money, I want to ask you, I want to go back to self-employed, because I could keep you here for hours. You know that, right? I'm not going to do that to you guys. This is not that.
Gotta have some more
But I
coffee.
could keep you for hours, because the more I'm educated in financing, the more I can help my clients. The least I know about financing, the least I'm actually in a space land where I know nothing. I need to know everything there is. So when I talk to my clients, and I can show them and I can help them, you know, by explaining things to them, and then I can introduce them to a phenomenal lender. Okay. I want to ask you. You were just talking about, you know. I want to ask you about. Do you guys work with someone who doesn't have cash, someone who doesn't have liquid cash right now to buy homes, but they want to become an investor, but they do have the liquidity, but got it in a form of an equity and possibly 2 or 3 homes that they already own. Can we cross collateralize these homes to purchase another investment? Because we're using the equity, and a lot of these homes have a lot of equity. They truly do. I was talking with the realtor before I was coming here, and she's got a property worth about $280,000, and she only owes $65,000 on the property. And it's valued at $280,000. There is a lot of equity there that you can do one of 2 things. Let's talk about it. HELOC. What is a HELOC? Home equity line of credit. But in order to go into a HELOC and get a HELOC loan, you have to be a W-2 employee. You have to show a salary, 2 years tax returns, and it's got to be a positive tax return. There has to be enough money to show that you qualify for this loan. So today, we're not at a salary employee. We're talking about self-employed individuals. Ask the lender who called me, ask the realtor who called me this morning. So she's got a lot of equity there, but she would like to buy a secondary property, another investment property that's going to give her a positive cash flow. Okay?
This
Can
came
you
up.
guys work with that?
This came up. I shopped that loan probably 7 or 10 days ago. A very similar situation, and this is a little bit the province of Wall Street commercial land. You know, like similar to fix and flip stuff. And they would have called it a portfolio loan.
Got it. Exactly.
So there would have been one of 2 alternatives.
Exactly. That's what it is.
Either you
Portfolio
had
loan.
so many doors, and each door was valued at X amount, and you would get a portfolio loan, and if one of those was a purchase, they would contemplate it.
Exactly.
But in the case if it was less than a certain aggregate, like $1 million loan, they will probably try to just do a cash out debt service loan
Got it.
on each of the properties, and then you could make your purchase with your liquidity and still qualify in that debt service range.
So this is again for a self-employed individual, correct?
Yeah, this is for somebody but their own business.
So they're self-employed, whether they own their own business, they usually do.
It could just be a landowner,
Exactly.
because you have performing real estate.
Exactly. Something that's giving you a positive cash flow coming in. That is phenomenal. It's great to know that you guys also do these cross-collateralized, also known as portfolio loans. Phenomenal to know. Okay, when you have a creative portfolio that you've got, like for example, this lady, she's got 17 properties.
Right.
These friends of mine, they have 350 properties, and they started out with me, I would probably say about 18 years ago, with one property is what they bought. 17 years later, or maybe close to 18 years, they own about 350 properties. But one of the things that they said, Ishmael, you have to have the incentive. You have to have the drive.
The desire.
The desire, because we can show you, we can teach you, we can provide you the tools that you guys need, but I can't get you out of bed. That's gonna be a tough one. If you don't want to, if you're not self-motivated, I'm truly self-motivated. You
got me out of bed.
Yeah, exactly. I'm self-motivated because I love our job. I love our job as a realtor. You love your job as a lender. We love helping people, and we love making money as well too. So I think it's the right line of work. But anyway, I've got another one to ask you.
Sure.
Okay.
Shoot.
So we've crossed now self-employed. We've covered self-employed. We've covered cross-collateralizing portfolio loans. Okay. And I think another loan that I would highly be interested in as well too is going to be a loan that, for example, well, I guess that would fall more into the hard equity lending. The individual who their credit score, a lot of people don't know how important credit is. They come from other countries where, it's not credit score driven.
Yeah,
it's not credit score driven. So credit's not like a big thing for them, having an 800, 700 score, that means nothing to them. They're used to going to their bank and, and being probably recommended by someone. This is a great friend of mine. Go ahead and lend them $20,000. That doesn't work here in the U.S., okay? So credit score is everything. But let's talk about those guys. We're going to have individuals that I do have them come in here. They're hardworking. They make great money, but they really don't care about, and they've got great jobs. I mean that. I've seen them with great jobs, but they don't care about their credit, and that to me is, I don't understand that one sometimes.
It's a change sometimes. I have a very successful flipper from Uruguay, and he actually had a grasp of it that I had heard before, but not in his particular words. And his sense was that America works on the trust system, and that trust is evaluated by your credit score.
Oh, okay, there we go. I was working on that.
Yeah.
Okay, I love the part where you made it into finally said it's based on the credit score, because
right.
I would love to take you to you take me to your bank. And when I go, they go, oh, this guy Ishmael, he's a phenomenal guy. I trust him a great deal. Lend him a couple $100,000 because I just trust him. You know what they're going to tell me and you at that bank? Mr. Alvarez, take the other Alvarez with you. You guys get out of here, okay? It's credit score driven. So the trust system is the credit score, because the credit score will explain exactly who you are. Do you pay on time? Do you pay everybody on time? Are you a very well budgeted individual? They can lend you, for example, a credit line of $20,000, a credit card, but you don't abuse of that credit card. You have it at a $1,500, $1,000, so you don't abuse of it. But if you got a $20,000 credit card and you owe $19,000 on it, you don't really manage your money correctly, okay? So again, someone that doesn't pay on time, there's where the trust comes in. There's where the trust comes in.
Yeah.
Our credit says exactly who you are. You want to look at someone and pull their credit. I think before someone should get married nowadays, they should say, okay, Mr. Alvarez,
What's your credit score?
can I see your credit report? And it's going to tell me all about you. Bad joke, right?
A little bit. I can think of one worse, but I'll keep it to myself.
Okay, bad joke, guys. And I'm a pretty good broker, but not a great comedian, as you guys already know this, you know. So that was a horrible joke. But, yeah, I don't know. You're used to, thanks, Sarah. You're
Sarah, what is your credit score? Oh, no.
It happens mostly with renters.
With renters.
I've had horrible experiences. People who've got good jobs,
Exactly.
lots of money, and cannot get into a good Terracina, Black Diamond,
Exactly.
Olympia, 700 credit score or better. Not one less, not 1 point less.
Exactly.
And they cannot get into these places even though they could nearly buy the places.
I've had them.
So I discovered the importance of credit.
Your credit
And I
report,
have to explain it to people sometimes. Well, what I got, you know, $200 in my bank. I make this, I do that. And boy, that's what the HOA has laid down.
Precise. And those are the rules.
And they say that if you do your credit, don't care what you have, it's gonna be $400.
Yeah.
It proves that you have not been a good steward of the funds that you came.
yeah, you haven't been
in contact
serious with the people that have trusted you.
with.
Exactly.
Yes, you have not been a good manager.
Exactly.
So
Manager is another great word.
Exactly. You know, I've had them that have come in and they've actually said to us, we will pay the entire year up front.
Yes, I have that.
The entire year up front. But unfortunately, guidelines and bylaws and rules and regulations are to be followed. And they're there for a reason. So if your credit score is not adequate, they just can't break the rule because you've got a couple $100,000 sitting in your account.
Right.
You know, if you really think about it, well, I'm not even going to answer that one. But your credit really speaks for you. People should take, you know, they should take an interest in fixing their credit because it's all about you. It says exactly who you are. And then if you're a single person or you're starting out, you're ever going to have a family, you need your credit. If you're ever going to have kids or anything like that, or grandchildren, you're going to need the credit there to be able to help others or other family members
You
or
wanna hear
yourself.
something ridiculous? There's a very good project down here. It's called the Alvarez, right off 441.
I know it, yes.
Beautiful homes in there, large homes, extremely reasonably priced for rent. But if you don't have that credit, you cannot benefit
You-
by it. I've had a rabbi, and you know rabbis' wives, they don't get involved in money and all that kind of stuff. And they say every person has to have this 700 or better.
Absolutely.
And she has never had credit.
You see what I mean? And she's not a bad person. She's a
Right.
phenomenal person,
Never had credit,
but don't
she
believe
did
in
not have
credit.
credit. Yeah.
And I run into that myself a lot too. So that's why I thought I'd bring this up with Mike. What do we do, or what programs do we have available for individuals like that? What programs
Oh, yeah.
do you recommend, Michael?
For home ownership,
Now, they've got good money.
They
These people
have-
have money in their accounts, but their credit scores are just, they're not there. The credit score is not there.
I believe there is a no ratio program, but it's preferential for investors. Like if it's owner occupied, you're in the hard money territory, and
Right.
you're a little bit going to be bending steel here because, you know, if you get the right leverage, you can do it, but they will likely want that person to form a company, buy the property in the name of the company. I've heard that that can be done.
I deal with clients like that for years and years and years. Okay, I run into those type of clients and I don't lose them. And I want you guys to know how not to lose that client either. Because when you do tell this client that their interest rates, this is for someone who's going to buy a home and they've got their credit score is very, very low. They make good money, they got a good job, but again, their credit score is very low because they just don't believe in credit. Okay. The way that I explain it to them, and I'm gonna have to get my assistant here, Michael. I just turned you into my assistant.
Okay, I'll be
Okay.
an assistant today.
I always ask the individuals, you know, how much are you paying for in rent at this moment? Rents are through the roof. Dear Lord, are they through the roof? You know, they're like, if you find something at $1,500, $1,600 per month, boy, you're a fortunate individual. But rents are like $2,300, $2,500, $2,700, and even greater. So I'm just going to use something very, very simple. If you could grab that pin right in the top there, and just write in there, say, let's just use, I don't know, let's use $1,800 per month. Just write in $1,800. Okay? Now, here's the thing. Individuals look at interest rate like money in the garbage, thrown in the garbage. So rent is the same thing. It's just money just thrown right through the garbage, okay? I always ask the question,
Go ahead.
would you prefer to pay 1,800% interest rate, put a percentage sign right after monthly, right there, put a percentage sign. Okay, and now put minus at the bottom underneath it, no, a little over here, minus 15%. Just put 15 right here, minus 15, and then put the percentage sign. I'm gonna be really honest with you guys, and if you could do the math for me, just put a straight line across the bottom there, and I want you to, at 1,800 minus 15, give me the difference of 1,800 minus 15. I'm horrible with, nowadays I'm horrible without a
It's
calculator.
like 1530.
That's 17. Try a calculator there. 1,800 minus 15.
Minus,
15%.
so 1800
We're at
times
1,800%.
15% is equal to 270.
No, minus 15%. 1,800 minus 15%. It is 1530?
Yeah, I mean,
Okay.
10% being 1800, half of 18 is 9, 9 and
Got it.
18,
Perfect.
27,
Thank you.
27.
So look
It's
on,
30 difference, add to 15, it's
then put the
1530.
percentage sign right behind put the percentage sign. We lost it there.
How do I
But
do
anyway,
it? How do I do it?
There we go. So put the percentage sign. Look how much money your client is saving. 1,530%. Are you kidding me? That is a lot of huge savings. And now your client owns the property. They can remodel, they can upgrade the property, they can sell the property, they can rent the property because they own it. Can you imagine on a rental if you start upgrading that property and paying $1,800 per month? The landlord's going to love you because not only are you paying their mortgage, you are also remodeling their home. So I prefer to pay 15%. And then I own my own house. I can write off the interest rates, the taxes. I can, remodel this home, and it's my house.
Yeah.
So
yeah.
if you do the math,
It's personal.
that's a big savings. So when you explain it to them like that, do you prefer to pay 1,800% or 15%? Which one of the two? People now understand it a lot easier, and they're very comfortable with the 15%. And again, going back to that self-employed individual, going back to that individual at this point, can pay this loan off early. They can pay it off within 3 years. They can pay it off within, 2 years, and so forth. Why? Or 5 years. It just makes a heck of a lot more sense. But at least you're not renting and throwing your money away. Because we're in South Florida. Property values here are going to continue increasing and increasing and increasing. So, it makes a heck of a lot more sense. So, yes, with the hard equity loans like this here,
Right.
even at 15%, it still makes sense to do a loan like that.
It's an imposed savings account. Somebody that buys a house has a net worth that increases on average nationally about $50,000 within a year.
Absolutely.
Just because your mindset, it's not quite the vaunted investor mindset, right?
Right,
But it's a savings program that, you know,
It's
your home
huge.
is often your largest investment.
Oh, it is, without a doubt. And this here, again, now you own your own home, and it's a big difference between, you know, paying rent to someone and not owning a home to actually owning your home. But when you look at it like this, like money thrown in the garbage, because people, they consider interest rates and they consider rental payments to be the same. It's money just thrown into the garbage, you know. So when you look at it like this, it makes a heck of a lot more sense to get a home at 15% interest rate. And you can pay it off early as well, too.
It's not the only thing. You know, the rate of inflation is going to increase the value of your home.
Absolutely.
So-
Now with the day, when you go to sell that home, when you go to sell that property, whether it's 2 years down the road, whether it's 3 years down the road, now you've got, you know,
3% of the value of the house if it's 250, right? So another 700, or what's 3% of
Yeah.
250? So
I'm horrible without a calculator,
So-
sorry. Can't help you
I
guys
got to
with
figure
that.
out 1%. I
What
think
you consider
it's 7,500.
Ishmael is because I had the experience.
So, all right.
But
Thank
you've
you.
got, but you're making profit. You're walking away with profit. You're walking
Yeah,
away with
that's a
money in the
yield.
pocket.
That's your yield.
No, that part I
I-
understand. I
Yeah.
don't understand very well the part when you said 1,800 minus 15%.
The $1,800 is what you're paying per rent. That's money thrown in a garbage can, correct? Because if you think you're saving that money, I don't think so. So where are you throwing it? Into someone else's pocket. Pretty much well throw it in a garbage. You're throwing it away. Let's just use the word throwing it away. You're throwing it away. Okay? So what would you prefer to pay? 1,800% or 15%? There you go. So do I. I prefer to pay 15%, but I own the property. And a very important factor, what Mike just said, at the day I go to sell that property, whether it's 6 months, 8 months, a year, 18 months, or something like that, that someone's going to come to you, and now you've remodeled this home, you made it look very lovely, and you're going to walk away with $60,000, $70,000 of profit. Now try to walk away with $70,000 of profit. Wait, this is a funny one. Here's one of my jokes. I know you guys might not find this funny, but try to walk away with with $70,000 of profit on a property that you're paying $1,800 a month and it's not yours. You just committed fraud. You just sold a property that's not yours. So you will end up at a very nice resort, a very nice hotel. They serve like 3-course meals a day. There's exercising that you can do.
Federal hotel, yeah.
Guys, I'm okay being a realtor.
And a nice outfit too.
With a nice outfit, you know, nice clothing, washed every day. No, listen, I prefer to pay 15% interest rate, guys, and stay here.
What I was gonna say is.
You didn't like that joke.
Yeah, no, that's cute. I had a friend paying $2,500 a month, young couple. And I said to him, you know, if you have a relative or somebody, you could borrow at least $10,000 from. I
Absolutely.
can get you in a property. And he went and he borrowed his $10,000. Because I showed him that depending on how much he pays for the place he buys, he could pay off that $10,000 in about 3
Absolutely.
years. Because I said to him, the money you were saving, you would have been paying it right
Yes, sir.
anyway.
And he owns
So
it.
if you meticulously take that money and give it back, in 3-4 years, you've paid off the $10,000. You own a home. I put them in Winston Trails.
Yes, it's great community. They're all great communities. You sell in good communities.
Yeah, I borrowed the money. We got him into the home. I think his rent, his expenses, fixed expenses, were somewhere in the region of, I think it was 1,600.
There you
And
go.
then we said a little extra for
The
the
principal.
variable expenses.
Okay.
So he could have saved at least somewhere around $800 a month, 70, yeah, around,
Makes sense.
yeah, around 8, yes.
Makes
7 or
sense.
8, anyway.
Makes sense.
And I said to him, pay that back.
Exactly.
towards the loan
That you got.
meticulously, because because if you were paying the rent, you would have to pay it.
Exactly.
Take it and pay it back.
Exactly,
And now
exactly.
you have a lovely home right there in Richardson.
With great advice that you gave them.
Yeah.
See? Financing, knowing financing, I probably say it's about 50% of our career. We need to know every aspect of financing, and then we need to pick, Michael's brain like this as we're doing. Because the more we learn about Michael, well, not Michael, but his mortgage,
My brain.
his lending experience, the more we learn, okay, then the more we are able to help our public. So, got one more. I know we've kept you here for a while.
Shoot.
And I would love to keep you here for even longer because I've got so many more
I'm
questions.
having a little bit of fun, actually.
Good, thank
Yeah,
you.
yeah.
Thank you. And hope to have you back again because I've got another list of more questions to ask you.
Well,
Okay.
next time I'll be ready for you.
Okay, awesome. No, you actually are. You're answering every question perfectly. We work also with a lot of high-end homes, and we sell a lot of homes. So these individuals, in many occasions, they have these homes that are worth, a couple of $1 million to up to $8, $9, $10 million, okay? And they're paid for it, but they found another property that they don't want to lose, okay? So bridge loans. Do you guys work with bridge loans to where, again, it's the same thing as cross-collateralizing both properties, but once the other property is sold, then the funds from that property will pay off the property they just went under contract with.
Our
So these
most
bridge loans are,
Our most successful investors in that scenario would have maybe had a relationship with me or even their bank to have the HELOC on their
Right.
existing home because then they can just write a check for that property.
right. But I have had them. We don't get them that often, but I'd have to tell you that I get at least between, half a dozen a year. Half a dozen
Wow.
a year with bridge loans, okay? They're purchasing a property, maybe not, again, maybe not $8, $10 million, but they're purchasing a property for $1.3 million. And the home that they own is probably worth, 1.5, 1.8, but they're either downsizing or they're upgrading. They're upgrading on their home. They're getting a home for a lesser value, and the home that they own is at a greater value, but they're getting a phenomenal great deal that just arise. And great deals arise all the time. You just have to be looking for them. You have to be looking for them on a daily basis. As we spoke yesterday, farming. How often do you have to be farming your area? Daily. Remember we spoke about that yesterday? Daily. So if a good deal shows up like that, and we're talking about, high-end loans, okay? So we're talking about jumbo loans. Do you guys also work with jumbo loans?
Yes, yeah, there's some really terrific jumbo loans. I'm doing, I think I have one in the low threes that I'm working on now. They are more credit sensitive. You have to have a
Yes.
700 credit
Yeah,
score for a
without
jumbo
doubt.
loan.
Yeah, without a doubt.
Um,
Usually they do. Usually these individuals, I've always seen they do. They do.
And the doc type is going to be more sensitive. No doc or no ratio or there was a bank before COVID that would go ahead and make the loan with the understanding that you hadn't sold your home yet.
Right. But did they cross-collateralize the other home?
In that sense, they offered a grace period that you would sell your other home.
Nice.
For outright cross-collateralization, that's a good question. For an owner-occupied property, the laws are such that there's a large number of laws that protect consumers.
Right.
And so a consumer that says, when you tore the Band-Aid off, it really hurt,
Yeah.
has legal eagles coming from across the nation to defend
Yeah.
this person, where
Exactly.
if it's an investor, that scenario doesn't exist. There's the understanding that the investor is probably an expert. So if they're buying it as an investment property,
Yes.
a bridge loan would be more
Yeah.
likely.
Yes.
Probably be a top end 75, maybe 80% loan to value.
Okay.
There could be some
Okay.
strings attached, but
There usually are these jumbo loans. I'm glad to know that you've got them. that they're back again.
Sometimes
Because-
with jumbos, we'll do a first and a second combo, so they can get a rate on the first and the twos.
Right.
And then they get that interest-only second,
Right,
so they can use it to arrest their other debt.
right.
You know, I'm doing that one now.
Great, great. Well, we've got really good, we've got a lot of great information here today for self-employed, for people with hard equity loans, for even jumbo loans that I decided, that we would probably, cover that today
I
as well.
think I
too.
might be one of the first ones coming back with jumbo, because they're
With
just
jumbos.
starting to come back.
Yeah, the
so.
jumbo loans, we're just not seeing them. But I'm glad that you guys have them.
Yeah.
Mike, we would love to have you back again with us again, because I have another list of questions for you on other programs that I'm so interested in.
Ishmael, I really
For-
enjoyed being here.
Thank you, Mike.
It's so
Thank
good.
you for being here
Yeah.
once again, And I want to thank you guys for being with us here. Again, I'm Ishmael Alvarez with
Michael Alvarez.
And we will see you guys on the next episode.